Hi, my name is Roy Rumbo. I'm an accounting professor at the University of North Texas. And today I'm going to be talking about accounting for investments the company makes. Using this for my intermediate accounting 2 students at UNT. However, published on YouTube. And I want to give credit to McGraw-Hill, their textbook, the Spiceland, Nelson, and Thomas textbook, Intermediate Accounting. It's a great textbook. So with that, we'll share my screen and get started. There we go. My computer is a little slow today. So it's a Friday afternoon for me. So, maybe I'm wearing down as well as my computer is. And so I'm looking for my clicker, which I prefer to use because I use that mouse. As if you've seen my lectures, you know that that mouse gets kind of sensitive to changes. So let's just talk about investments here before I get started. So companies make investments for a lot of different purposes. And so maybe they're holding a lot of cash. And there's been a lot of companies like Microsoft, like Apple that have, 100 million, maybe billions of dollars of cash just sitting on their balance sheet, because they're just generating so much cash. And they are not willing to make a big dividend, although Microsoft's made some big special dividends to shareholders over time. But they need to park it somewhere that can earn money. So they may invest in bonds. When cash is sitting around, mostly that's going to be invested in fixed income, debt securities that are more stable, less volatile, and they'll get an earning stream from that. When you look at companies buying equity investments, this means buying ownership interest in another company. Now you open up a whole different set of reasons companies do that. Number one, they might want to be able to have, might be strategic and get access to more vertically integrated access to raw materials or parts or whatever else. And so at Lennox International, where I was a corporate controller, we had a 24.5% ownership in a compressor manufacturer. I think it was over in Mississippi or somewhere. And and Trane, our competitor, owned the other 24.5%. So we owned 49%. 51% was owned by Emerson, which is that's what they do. They make compressors. But that was a joint venture between the 3 companies. And so we always had access to compressors. And so in a really hot summer, people were buying a lot of air conditioners. And so we had compressors. So in that case, companies will make investments in other companies for a multitude of reasons. And then we have to do the accounting for this. So again, the investments could be equity or debt. And that's going to be a different accounting for each one of those. And so objective, earn a return from dividends from equities or interest from debt securities, and maybe get capital gains there. And also develop affiliations with those companies that give us some benefit, like we did with the compressor manufacturer. So we'll start with debt instruments. And if you remember bonds payable, because we do chapter 12 after chapter 13 at UNT. So I apologize for those who are just seeing this for the first time. You might want to look at the bond payable piece first, because I'm not going to spend a lot of time on that here in this chapter or even testing it. But, we'll get back into bonds payable, the other side as an investor. So we have the date, it matures, face amount, which is also the principal or the par value. You've taken my other, and that's going to pay interest to investors at a certain interest rate. And bonds could be sold at a discount or at a premium. If they're paying a market rate, like here, these bonds are being paid 12% versus a market rate of 14%, they're going to be sold at a discount, or they could be sold at a premium if the market rate is higher than the stated rate. And if you remember from bonds payable for my students, we start out with, on the bonds payable side, just to confuse you, the discount on the bond investment is a debit. And, we have the exact opposite entry in bonds payable: debit cash, debit the bond investment, credit bonds payable. So this is the opposite side, what the investing company would do. And they're going to take and amortize this bond down and record interest income, just like we did for interest expense and bonds payable. And the outstanding balance, as we amortize down the discount in this case, will approach 700,000. This is called the amortized cost method of for accounting. So so let me just kind of stop here because I've been going kind of fast because my students have already seen all that amortized costs, and I don't want to repeat all that pain for them, if you will. And so here is the accounting for debt instruments in a nutshell. Right here, this slide is the whole chapter for debt investments. Different for equity, we'll get there, but this is debt. We're going to classify each of our debt investments, and we'll visit these in the next few slides. Are they held to maturity? We're never ever going to sell them. We're planning to keep them. Or are they trading securities? We're like a bank. We're in a business of buying and selling debt securities all the time. Or are they somewhere in between? They're not really completely held to maturity, but we're not trading all the time. We call these available for sale securities. You see these more in banks. Usually you get into companies, you're going to either be held to maturity or trading, most likely. So the accounting changes and how this handles, both in the balance sheet side and the income side. And what we're focused on here is what is the fair value of these instruments, because that's going to be changing after we buy it. And should we recognize that fair value in the income statement, in the unrealized gains and losses before we sell it? Should we recognize that or not? And so you're going to see that for held to maturity, not recognized, and trading security, those changes in fair value are recognized. But guess what? In the available for sale, we recognize the changes on the balance sheet. We'll record them at fair value on the balance sheet, but the changes in fair value are going to flow through our old friend, the accumulated other comprehensive income in equity. So there will be an other comprehensive income. I don't know what I said. AOCI, accumulated other comprehensive income, inside the equity section, and they do not hit the income statement. I always call AOCI, the accumulated other comprehensive income inside equity, I call that a bucket of where we want to put things where we want to get the balance sheet right, but we're not ready to let it hit the income statement. This is a perfect example of that. The balance sheet, we're going to reflect these available for sale securities at fair value, but since they're not trading securities, not what we do, trading securities every day, we're not going to let it hit the income statement until we sell it. And so we park it, that unrealized gain or loss, in equity in AOCI, accumulated other comprehensive income. Trading securities, now we're going to recognize that net income every day because that's what we do. We're in the business of buying and selling these securities. That's what banks. And so the changes in fair value hit the bank's income statement every single day and get reported on their financial statements. Held to maturity, we say, hey, we're not planning to sell that anyway. These changes in fair value are not relevant. We're going to record it in amortized cost. What is amortized cost? That's these balances here of doing all the amortization table. We just report it here, whatever this math is, regardless whether the fair value is lower or higher than that. And I think this accounting personally makes sense to me. I get this, and I think this is they've done FASB's done a nice job with that. So here's held to maturity. The investor, and these are the rules, has a positive intent and ability. They don't need the money to sell this. They can just hold that to maturity. So maybe these companies with a lot of cash on their books, not planning to use that for any reason till way down the road, they will just put these in that held to maturity. Good for them because the value will be stable. At the end of the day, when these mature, it's going to be the face value, the principal that gets paid back to the owner of that. And so we don't recognize unrealized holding gains and losses. They are ignored. We may disclose them, but we're not going to recognize those. Trading security is the opposite. Active buying and selling. Holding period, I like this one, is measured in hours and days rather than months or years. Banks are buying and selling these all the time. I invest in fixed income. And so I call my banks. I want to buy a fixed income bond, that'll mature in 3 years. And boom, they've got one for me. It takes about a few seconds to close that transaction after they know what I want. And so these are carried at fair value, and the unrealized gains and losses are included in net income. In the period, every time the fair value changes, there's going to be an impact to net income. And by the way, are these current or long-term? Well, if we're trading them in hours and days, clearly these are going to be in current assets. In contrast to held to maturity, they are going to be in non-current assets. All right, available for sale, basically, what's the definition? Well, they're not held to maturity. There's a greater chance we're going to sell them, but we're not just actively trading them every day. It's somewhere in between. I think you'd have to have clear documentation of these that no, we're not holding the maturity, but also no, we're not trading them. And so it's listed and it's put in available for sale and be noted in the footnote for selling and reported at fair value on the balance sheet. But the changes in fair value do not go to the income statement like in trading securities. It's going to be parked over there in equity in the other comprehensive income. So gains and losses for available for sale would show up. We will have a statement, as we saw in the financial statement, a statement of other comprehensive income that will show the changes in other comprehensive income during the year. So clearly these changes will show up there. And, we talked about the unrealized gain. And so this is interesting because I think I forgot to mention in trading securities, because we're buying and selling these, they are going to show up on the cash flow statement as operating activities. Because if we're trading securities, that's what we are. That's who we are. That's what our operating activities are. Available for sale securities, though, are going to show up in investing activities, not in trading securities. And remember, cash flow statement has operating, and investing, and in financing. And get to chapter 21, the last chapter for intermediate accounting, the cash flow statement, you'll know more about this. So switching gears now, so that all that we just talked about only relates to debt securities that we own. Now we're going to talk about owning equity investments like common stock or partnership interest in other companies, ownership interest. And so we've got to think about how we account for this. We got to recognize or not recognize how we will recognize interest revenue, investment revenue. We'll look at that. And then what do we do with changes in fair value? So again, we're going to have different ways of doing it. And so here are the kind of three methods, if you will, if you think about it. If I call these cost method investments, so there's going to be three, like in debt securities, going to be three different levels of ownership, and we'll account for each of them different. And it's all about whether we have significant influence or control. We have control, we own more than 50%. Now, I'll start here. We consolidate the financial statements. We take all the financial statements where we have more than 50%, and we create one set of financial statements, consolidating all of their assets and liabilities and equity into our one set of financial statements. Yeah, you will learn that, and that's advanced accounting. But way beyond the scope of this course. So kind of wipe that one off the map a little bit here, and let's deal with significant influence. Either the investor has significant influence, and we're going to use the equity method, or it lacks significant influence, and we're going to use the fair value through net income method. So how do we define significant influence? And when you get to advanced accounting, there's more information around how some qualitative metrics to determine whether we have significant influence. But the starting point, even in advanced accounting, is do we own less or more than 20% of the the voting stock. If we own more than 20%, it's just de facto assume you got significant influence if you own more than 20%, and you're going to do different accounting. Now, what is accounting? If you own less than 20%, you lack significant influence. I've always called this cost method. You are going to report changes in fair value through net income, just like the trading securities. And when you get a dividend, you're going to record that as investment income. All right. How about if we have significant influence? I'll start with the dividend. For if you lack significant influence, that dividend becomes investment income. In the equity method, it does not. It becomes a return of investment. So where do we get investment income in the equity method? We just take a percent of their net income. So if the company made 100 million in net income and we own 25%, we're going to record net income of 25 million. And this kind of, reflects the fact that we had influence over the results of that operation. So I mentioned that we own 24.5% of that compressor manufacturer. So every quarter we would have to call the controller, of that business and say, hey, how much money did you make this quarter? And we would book our percent, 24.5% of that. And, we had board seats, so we definitely had significant influence. And, we never had any issues. They had good accounting systems, and there was never any, that I'm aware of, any errors or anything. So my hat's off to that controller and the many controllers that might have been there while I was a controller at Lennox. All right, so we're going to start with what I call the cost method, where we as a company lack significant influence. And so here's an example. We purchased 1.5 million of common stock. We received a $75,000 cash dividend, and we had record an adjustment down to 1,450,000. So that 1.5 million, we had to record an expense because unrealized loss, we hadn't sold it. It went down by $50,000. So we had to debit a loss on investment of 50,000 and credit that investment. So we brought the investment account down to fair value. When we recognized the dividend, we recorded income from that. And so you see that here. This is our first journal entry, investment. Here's our second journal entry for the dividend. Dividend becomes revenue. Remember, if we have more than 20%, we have significant influence, we do not record dividend revenue. So this is a difference here. And we will record an adjustment, unrealized loss of 50,000. This is because the value was 1,450,000. Now the textbook goes through a lot of these fair value adjustments, and different companies do it different ways. So I don't get into that with my students, nor hold them accountable for all those journal entries to get the fair value. But I do expect them to know, hey, when you lack significant influence and you have a loss in value, that becomes an expense. All right, now let's move to the second type of equity method investment. And that's when we have significant influence, but we don't have control. So we have a greater than 20% ownership, but we have less than 50. If you own more than 50, you have control. You got to do consolidated financial statements. If more than 50, I'm saying what they're saying, which is good, because if I was contradicting them, that would not be good. So, what does significant influence mean? Decisions can be swayed in the direction the 20%, the 50% investor wants. And we use the equity method. So let's look at accounting for that. Well, I'm going to get into all this consolidation stuff here. But here's a situation. So equity method, United Intergroup purchased 30% of Argent's common stock. And so the fair value of Argent was 5 million. We bought 30%, so we paid 1.5 million. During 2018, they are Argent, the one we own significant influence, they earned $500,000 net income and they paid $250,000 in dividends. So we're going to look at accounting for that. So first entry, debit the investment in Argent stock, $1.5 million, credit cash. That's for the purchase. Second entry is, as I said, in equity method, we're going to record income for our share of the net income. Why do we do that? Well, we have influence over that. Hopefully we had a positive influence and help them to make 500,000. So we own 30% of it. We take 30% of that net income and we call it investment revenue. Now we increase our investment account. We ignore fair value for equity method. So keep that in mind. We ignore fair value, but we increase our investment for this ownership interest. You'd almost think ownership of their retained earnings, right? Think of it that way. So our investment has increased by our share of ownership. And then second slide, I almost went too fast with my clicking there. We got paid dividends. So when we get paid dividends, and it was their total dividends were 250,000. We don't get all 250, right? Because we only own 30%. So we get 30% of those. We receive cash of 75,000. But then, unlike the previous example where we own less than 20%, we do not record investment revenue. We only record investment revenue for 30% of the income. We consider this like a return of our investment. And so we credit the investment in Argent stock. So remember, we started with $1.5 million in Argent stock. We increased it to $1.05 million, and then we subtracted 75,000. And so the value of that investment in Argent is going to continue to depend on our percent of their net income minus our dividends that we receive. So again, that is very different. So that's it. You know, I know there's a lot more in this chapter, but this is what I hold my students accountable for. And so I don't want to go do a lecture on things that they're important things, but I don't think we just don't have the space for it. We cover that McGraw-Hill textbook really from cover to cover at University of North Texas. We hardly miss a page, but in this chapter, I miss a few pages there that you're welcome buy the textbook. I suggest it and read that. So with that, I'm going to thank you for your time, and I just hope you have a great rest of the day or evening wherever you are. Thank you.